You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business.
Hey, it's Fuhr. Welcome back to another episode of Real Investor Radio, joined again by Jack BeVier. Jack, good to see you today.
Absolutely. Good morning. Great to see you.
I'm just going to jump right into it and introduce our great guest today. We've got Kevin Bupp on the show. He's a real estate marketing professional with extensive business development experience and a sincere passion for helping others achieve above average and safe returns. He has a proven track record in identifying and repositioning value-add multifamily and mobile home parks. Love that. Through a very disciplined due diligence and analysis approach. Kevin is also the host of 2 top 10 real estate podcasts, kind of flexing a little bit there, Jack. We'll get there one day.
Working on it.
Yeah, we'll get there. The podcasts are Real Estate Investing for Cash Flow with Kevin Bupp and the Mobile Home Park Investing podcast, both of which he's prominently displaying behind him today, shamelessly, Jack.
There we go.
And you can learn more about Kevin. Reach out to him at kevinbupp.com. That's B-U-P-P, or emailing him at kevin@kevinbupp.com. Kevin, welcome to the show, brother.
Yeah, Craig, Jack, thanks for having me. Excited to be here.
Yeah, man. Let's just jump into a substantive conversation. I thought that I would do some research today on sort of the state of multifamily, Jack. And what I found is that obviously with Kevin, jump in here anywhere. Multifamily in 2025 is sort of a story of two worlds between stability at the core and strain at the edges. I was checking out Bill McBride's Calculated Risk newsletter. If you all haven't checked out Bill's newsletter, it's just fantastic. And so Bill just did a story on the state of multifamily. Freddie Mac is reporting that single family serious delinquencies, Jack, which is 90 days or more, kind of ticked up. Nothing too significant, still at less than a little bit over 0.5% in July, where agency portfolios remain rock solid. Fannie's delinquency rate is the same. It's just above 0.5%. But the rise in multifamily defaults is, a couple of the main drivers behind that are in the CMBS side, Jack, where the delinquency rate is pushing 7% right now in some markets across the country. So I'd love to get your thoughts on sort of what we're seeing from that standpoint, Jack, and then really talk about, is there a silver lining? Are cap rates, stabilizing? Are guys getting better deals? Are we seeing, more transactions in the multifamily market? So yeah, jump in.
Yeah, Kevin, I'm really interested in your take on this. This is like my kind of anecdotal experience was like, we've always monitored the multifamily market. Dominion's been mostly a single family buyer, but always would like to buy multifamily properties. I always just found that like the delta in the cap rates between what a deal I could get on the single family and the multifamily next door, I just preferred the risk return profile of the single family. That kind of switched up last summer, I would say, or last year or early part of last year. I started to see that multifamily cap rates were expanding while single family had continued to stay tight. And so, we actually picked up a couple multifamily properties last year. And so I got all excited about it. And I'm like, sweet, this is going to be new phase of me buying multifamily stuff and adding it to the portfolio. And then over the winter and for the first 2.5 quarters of this year, 3 quarters of this year, multifamily, and at least local to me, tightened back up. And I was just getting blown out again and couldn't make it work. But the, kind of the relationships that I developed over that period of time with the brokers, they've kind of consistently been talking about there's inventory coming, and there's situations that are back there working themselves out. People are trying different creative solutions to make ends meet where cash flow isn't quite as good as it needs to be, or we're getting to a balloon payment on a loan. And so kind of just wait, there's still more coming. And I think we're just kind of seeing that now, at least in the Maryland area, that inventory is actually now starting to come out, and there's less capital available for it. And as a result, we're starting to see some cap rate expansion in multifamily right now. And that's just been my local experience. What do you say?
Yeah, and just for full transparency, we're we specialize in manufactured housing, and while I have quite a lot of LP personal investments with other multifamily sponsors, like that isn't our world. We don't live and breathe it every day. But I mean, I think there's a lot to unpack there. I think it's submarket by submarket, market by market, right? I think there's you'd mentioned like you had some deals look like things were expanding. There are going to be some good opportunities coming out, getting flushed out. But I think ultimately what's occurred is that a lot of two things. Number one, there hasn't been hardly any build. Anything that's come online the last couple of years was already in planning 4 years ago, 5 years ago, right? And so like there hasn't really been any new starts for the last couple of years, and so you had a lot of this excess inventory that's getting absorbed. And so now when anything comes back on the market, like there's a demand for that product, right? It's not excess inventory. In addition to that, you've got a lot of capital that's been on the sidelines, that's just kind of waiting and watching and waiting for the right time, waiting for the right opportunities to come out. So I think every market is living and breathing differently than the next. I do think that there's obviously going to be there's foreclosures and things like that will be flushed out. I mean, I get emails from brokers and the multifamily stuff. I saw one just come out yesterday somewhere in Texas. I didn't really dig into it at all, but it was a foreclosure, like a 650 unit apartment complex. Um, I mean, there's still appetite for that. I think a lot of these defaults were a direct result of two things. Number one, the debt they put in, like high leverage bridge debt. Number two, adjustable rate loans. And so, to your point, Craig, you mentioned the low default rate of the agency stuff. It's because it's long term, fixed rates, right? And leverage points that were significantly less than the 80%, or sometimes depending what the capital stack looked like 85% on some of these bridge products that were put in place years past. And so it's just I think there will be opportunity, but I think also there's competition of equal amounts that will be looking for that opportunity that comes out. And so I think in any of the major markets, I mean, like I'm in the Tampa Bay area, to think that you're going to be able to buy a larger multifamily property for a 6 cap at any time in the future, I think is foolhardy. That might be the case maybe if if you go to maybe some Midwestern markets, you might find a little bit more cap rate expansion than that of like a Phoenix or a Tampa or an Orlando, you name your large market. But, I think it doesn't change the fact that if you're a disciplined buyer and you work really hard, you look at a lot of deals, right? You turn over a lot of rocks, like you'll find something, right? Like that's what it comes down to. Like you're going to find something. You just got to be disciplined in your approach, and you got to maybe work harder than the next. And so I always, no matter what the market's doing, I always feel there's opportunity out there. 23 and 24 were literally our two biggest growth years that we've had in the last decade. This year, we thought we'd be able to maintain the same momentum, and we worked incredibly hard at it, and we looked at a lot of stuff, and we bought some great deals, but for whatever reason, we haven't transacted on as many in this calendar year. But we work our asses off to find deals and find needles in the haystack, and have capital available, and have a reputation that folks know, like, hey, when they bring it to us, like we can get the deal closed, no matter hell or high water, we'll get it closed. We'll get to the finish line. So anyway, now I'm rambling based on your original question, but yeah, I think there's a lot going on. You mentioned the CMBS, I haven't looked at these data points for quite some time, but you referenced that CMBS is quite a bit higher, their default than agency. And was that specifically CMBS loans tied to multifamily, or is that just CMBS in general?
It was CMBS tied to multifamily.
That's surprising, only because again, I don't know what I don't know. We've done a number of CMBS loans, but typically, they're not they're not high leverage point loans. They're typically fixed for at the shortest 5. Most of the time, they're 10-year term loans. And then, a couple of years ago when those were being originated, they were probably pretty competitive with where agency was at. Maybe not as competitive, but they were probably, somewhat in line with where the rates were at. So a little shocking to hear that the CMBS multifamily loans have literally a 7x default rate over that of agency. I'd love to dig deeper and figure out why that is. But I thought you were going to tell me that that's also tied to like office, because obviously office is a lot of those loans are typically CMBS loans, and as we all know, office is having some challenges at the present time.
Hey, I'm curious about your experience as an LP investor. We're generally not, like, we're usually the sponsor when we're doing deals, but we made some LP investments back in late 2022, thought that we were being really picky about it. And we were focused on the debt issue, right? Like having that longer term debt. And so, we thought we'd be, as interest rates rose, we were like, hey, yeah, stuff's getting messy, but we're going to be okay because we got this long-term debt. And I think we probably made like 4 investments. We still had one of them. Like we're now an activist investor because the dude's like, just completely not, executing extremely poorly, right? And so now we've like rolled our sleeves up to try to get our hands on the keys and because it's just not going very well. How have your LP investments gone?
Yeah, it's all across the board, and mine are pretty diverse. I think I'm an LP, and I think it's like 23 or 24 different deals, and most of those were made probably between like 2018 and 2022, give or take. Uh, and it's a wide range. It's assisted living, it's multifamily, some industrial in there, um, a couple retail investments. So I mean, it's all across the self storage is another one. And I would say that there's one self storage deal out of the three that I'm in that is struggling. Good operator group. I think just got out in front of their skis a little bit with their underwriting at that point in time when they bought it. And I don't know what else to say other than that because a lot of the other stuff in their portfolio is doing well. I just think they overpaid at a point where there was FOMO, fear of missing out. And so I think getting back to being disciplined, I think they lost that disciplined nature that I knew them for when everyone else was fighting for the same deal. The multifamily stuff I have is a mixed bag. I'd say that the two that are challenged right now are literally debt related. They both have made capital calls, a number of capital calls. They've had extensions put in place by the lender. Lender's been cooperative. I would say both those operators are actually executing, really well. They're communicating well. That they're owning it, and they're in the trenches with everyone else. And so I don't have a complaint there. It's just the investments. Yeah, the investments. I think just again, no one knew that rates were going to change as fast as they did, as aggressively as they did. But if we had a crystal ball that worked, then I'm sure they would have made different decisions back then. But I've got a couple other LP investments in multifamily stuff that kind of went in like they were kind of A-class properties. There wasn't a massive like loss lease recapture. They were more coupon clippers, and so they tied in agency debt right on the front end. And obviously, time typically will heal all wounds, right? And so that's those things haven't produced as high of a return. But guess what? They're still paying distributions when everything else isn't. So, it's really a mixed bag across the board, but really the multifamily stuff I have is the one that's suffering. Everything else, with the exception of that one self-storage deal, is performing and it's paying. So maybe not performing to the original projections entirely, right? But a few that actually have exceeded expectations, but not many. Most of them have missed the mark, but they're still paying out.
Yeah. Craig,
Yeah,
let's go ahead.
Yeah, let's just jump into give us like a brief background of how you started, why you got into real estate, and bring us up to speed to today. Try to truncate all that into a sentence or two. I'm sure.
Yeah, I'll do my best.
Take your time. To
keep it brief. So, I'm 46 today. I got introduced to real estate at age 19, so I was pretty young and bought my first property at 20. And I always joke and say that real estate found me. I didn't find it, so very grateful and feel blessed that happened. It was single family. Yeah, I met a guy, David. Actually, the girl I was dating at the time, her mother had been recently divorced. He started dating this local guy named David. David happened to be a local real estate entrepreneur, business owner, and that just by seeing him over at her house, I'd go visit her. I mean, again, we were like 19. We were in community college at the time. I got to know him. Like he was just a nice guy. And I didn't grow. I grew up very, parents both blue collar. Neither went to college. Just middle class. Didn't have a lot. Didn't go without. Right. Like it was all relative. I thought we had everything we needed back then. We weren't poor. We had a nice home and all that. But went on one vacation a year, like that type of thing. But both my parents worked, and we didn't have any business owners in our family. I didn't know any business owners. Right. That was just very foreign world to me. But I met David. A couple things I noticed, the first couple times I met him, he always dressed a little snazzy, at least in my eyes, like compared to how my parents dressed. He dressed a little snazzy, drove a really nice car. It seemed to be around. I would go visit my girlfriend, like if I was in between classes or something like that. And then David would like pop by the house randomly. And in my mind, people of that age had 9 to 5s, right? They should be at work, not out and about at 1 o'clock on a Wednesday afternoon. And so that was just intriguing to me. And as I became friends with him over the first couple of months, he got to know a little bit about me. I mean, I was tending bar at the time, going to community college, not really knowing what I wanted to do. I'd always been entrepreneurial, literally shoveled snow, mowed grass at a young age, got a paper out at age 12, learned how to install car stereos in people's cars back when that was cool to have loud stereos. I was 14, 15, did in my parents' garage, and was always trying to make money so I could go buy the material things that were important when you're a kid, right? Sports equipment, bikes, all that kind of stuff. So, and I knew that my parents, like it either came at birthday time or Christmas time. Like those are the two holidays where maybe I got one of the items that was like on a potential wish list, right? Outside of that, I better go figure out how to buy it myself. And so you fast forward, David, he invited me down to a conference of his. I didn't know anything about what he did other than he owned real estate and he had tenants that paid him rent, right? He'd go around, collect rent. And he invited me to a conference down in Philadelphia that he had already paid for himself and he had like a kind of like a silent business partner, and his partner couldn't go. And he invited me. Honestly, I had no idea what it was going to entail. I just said yes. I'm like, this guy paid a couple grand to go to this thing. He's inviting me. He obviously seems to be pretty successful. I don't know what the hell I'm doing in life right now. So I want something. And so I'm going to go and see what this is all about. And so that was the start of it. It was Ron LeGrand. He's still around today teaching, I think. Yeah.
Jack, have you ever experienced a Ron LeGrand event?
Oh my God.
I've never had the pleasure.
It's a circus.
I've met Ron several times and went to a multifamily event and several years ago. And Ron's getting up there in age now.
He's got to be
and
90
so
years old.
He's got a stage, and then there's like a table on the stage, and he's sitting at the table in a chair with a desk, and he's just reading from the frickin', the notes in the big binder that you get. And I'm like, I'm not learning it. I like you, Ron. You're a good guy. You've got insane experience. But like, I think we could bring this info to life a little bit better to keep the huge audience, by the way. Massive.
Yeah.
There's probably still 150, 200 people in the ring to see this thing who paid big money. So go ahead, keep going.
Yeah, no. So that's how that event was. I went to. It was all about how to fix and flip and wholesale single family homes. That was the topic of that particular event I went to. And that's not what David's business model was. Like he was kind of a buy and hold guy. Like he would sell some stuff here and there, but mostly everything he bought, he would do a renovation and then just rent it. And he had done that for years. And so anyway, I went to this conference, a couple hundred people there. And what happens, I met a number of folks that I felt weren't really smarter than I. They knew something I didn't, but they were making, in my eyes, like just tons of money, right? Like doing deals, wholesaling deals, making $5,000 and $10,000 checks or 30, 40K on flips. And, met people that had portfolios of rentals where they were making 20K a month of income. And like, that was just, I was like, man, this is it. I don't know how yet, but this is what I'm going to do.
Right.
And so I came back from that event and I knew that if I didn't take some type of action, it was overwhelming because I didn't know where to start. All I knew is that I knew David. And so, I identified a few areas where he struggled. He was 25 years older than I. And so like technology was new to him. Like a flip phone was new to him, like emails, like that was just a thing that was a foreign thing to his business. And he struggled like returning calls and this, that, and the other. So I saw areas where I could maybe help him in his business. So I made him an offer. He couldn't refuse. It's basically, let me come work for you for free. I only worked Thursday and Friday nights at the bar. I took 12 credits at the time, so I had a lot of time during the week. And I said, let me come help you. Maybe I saw him struggling to put together a PowerPoint for a pitch for one of his private investors. And like it literally took him 4 hours to do what should have taken like 4 minutes, right? And so I helped him there. I helped him I'll say, hey, let me return your phone calls for you. He had rentals that were sitting around for 2 months. He's like, I don't know. I'm like, you got like 9 voicemails in your phone, like, what do you like? Let me return these things. Right. And so I just acted as like an assistant. I was there helping him out, dropping off leases, picking up leases, whatever he needed, and I did that for like 14 months. And we spent a lot of time together and I got to learn, how he did it, why he did it, what he said, who he said it to, why he said it, all that stuff. And that was the start of it. I went and bought that first property, about a year after he and I started working together, and used about $7K of my own money that I'd saved up bartending and leveraged one of his private investors I got to know over that year. And he funded, a piece of that project. And that was it. That was the first one. Bought as a rental, had intended to renovate it and just rent it. And I did that. I realized very quickly that my model, it just couldn't mirror David at that point. He had been doing it a long time. He had a lot of capital. He had, access to bank relationships and loans and all that. And I didn't. So I ended up selling that property within 6 months of me renting it to another investor that wanted a rental. And then I basically morphed my model a little bit more and to where I would wholesale a couple houses. I got really good at marketing, got really good at the whole, guerrilla marketing stuff, bandit signs, back then classified ads in newspapers.
It was so much easier.
Yeah. Even billboards, that kind of stuff. And I got really good at marketing and, creating deal flow. And so I just started wholesaling a couple, keeping one, wholesaling a couple, keeping one. And that really evolved over, my early to mid 20s, where I ended up building a pretty big portfolio of single family homes and some multifamily properties. And then lost everything in 2008, kind of started over again in 2011. And that's when I got introduced to, mobile home parks, one of the assets that we're focused on today. And so back in 2011, bought a mobile home park that was distressed, turned it around, kind of like kicking off, phase two of my journey. And
What
bought
area of the country was that?
that was Atlanta. That first one was in Atlanta.
How many units?
It was a 34 unit. It was an REO. It was interesting. This is still like 2011, 2012. Everything was still in distress, right? There was a lot of fallout.
Atlanta was
still
amazing in 2011,
yeah.
2012.
Yeah, you could buy everything. And this was it was an REO, had been vacant for a year. And they basically, the servicing, special servicer came in and kicked out all the tenants in these units. All these units were like park owned homes, which is not a standard practice or model today, but like they're all owned by the property owner. And the special servicer came in and literally removed everybody and then boarded up these units, took away the stairs and all that stuff. I mean, so when we bought it, it was empty. A lot of them have been vandalized. People came and stole the AC units and all that. But we bought it at a price where I was like, if this doesn't work, I can at least sell off each one of these homes as a fire sale for probably $10K a pop, still have the piece of land underneath it and make all my money back just by selling the homes. And like, that was my plan B. And so bought it, renovated it, turned it around, sold the homes off over the first year and a half, did a cash out refinance, and I was off and running again for the second time. So just really,
I have to
go ahead.
Have to ask, what happened to the girlfriend?
Yeah, we were still friends. I mean, she went off, did her thing, got married, moved out. She actually lives out in California now, and so it was. Remain friends, split at, basically what happened is I grew up in Pennsylvania, a small town, and I couldn't wait to get the hell out. I just couldn't. Number one, I hate cold weather. Number two, I needed a little bit more energy around me, and it was just small town mentality. And so I moved down. Once I did about a year and a half of my own deals up there, I wanted to move somewhere warmer. I was always a water guy, and so I moved to where I'm at now, Tampa, Florida. Came down here and just went gangbusters. It was just like an eye-opening experience.
Nice
and
choice.
So I decided I wasn't gonna bring. My buddy always says, "Don't take sand to the beach." So my girlfriend and I split up at that time. I moved down to Florida and really started fresh and
Kevin, I feel like we're living parallel lives. Only you've just executed better. I always like to tell the story of when I got started in 2004. I had no money, none, and I go out and take this class, get that first deal. My girlfriend's father funded all the put up 100% of the money. We flipped it in 90 days and we netted $98,000 on our very first flip.
Wow.
At this house, this crappy house up in Baltimore. So, but I wound up marrying the girl. She didn't get away. So yeah, but strangely enough, she's in Tampa right now looking at colleges with my daughter. So I might be down there sooner than you think. Yeah, man, got to get someplace warm. So
I grew up in Harrisburg, which is really close to Baltimore. I mean, an hour and a half away.
Of course. So bring us up to speed on sort of like your transaction volume over the last several years and, what you're super focused on right now from an investing standpoint.
Yeah. So we typically stay in our lane. And so literally up until 2020, all we bought were mobile home parks. Like we just try to go all in, go deep and be the best at, in a particular niche. And so that's what we did, grew Sunrise into, a pretty significant size organization. At this point in our journey, we've got about 400 million of manufactured housing in our portfolio today. And, I've always viewed myself and my partners kind of the same way. My business partner as, just contrarian investors. We started buying parks when no one else was buying them. And now it's a lot more competitive. It's a lot more difficult to scale a, meaningful size portfolio because they're not making more mobile home parks, but there's more people getting into the space that want to buy them. Right. And so you get this supply demand imbalance that creates a challenge. It's great when you're selling, but it's very difficult to buy, quality assets in quality markets at a price that can still provide a return on investment. It's more and more difficult to do. And so we're always open, keep our eyes open and don't want to chase any shiny objects. Are really good about not doing that. But I think about 2018, I interviewed a guy on my podcast who owned a bunch of parking lots and parking garages. And I've been through these interviews before of asset classes I didn't understand, asking probing questions, getting a better understanding of the business model. And that was a business model where I got off that call with him and I couldn't stop thinking about it. I called him the next day, spent an hour on the phone, flew him to Tampa, 2 weeks later, spent the day with him. And just, I went to a bunch of my partner. I started going to all the different association meetings, national conferences that revolve around the parking industry and just getting to understand it better and took our first dive into the asset class in 2020. So studied it for a couple of years. and then started buying parking assets back in 2020. So those are the two verticals: mobile home parks and parking. Parking does consist of it's a little bit of a mixed bag. It's either a surface parking lot or a parking structure like a parking garage, but all of which are in growing markets, downtown urban locations, have a variety of demand drivers of why people are parking there. And so that's really the two things that we do. We do it day in, day out. We don't really, we don't chase any other objects. We don't chase, anything, trends or anything like that. It's like, do what we're really good at. We've got a whole infrastructure in place that supports both those businesses. And just, we try to be disciplined and buy assets that make sense and pass on the ones that don't. So the last 2 years, I'd referenced this earlier, and you just brought it up again about, kind of what the last couple of years have looked like. I went through this '08. I went through '08. I lost everything, lost my primary residence, had, tens of millions of dollars of judgments and liens and lots of fallout from that. So it was a eye-opening time. Thankfully, I was not married at that point, didn't have kids. And so a little bit easier to work my way through that and navigate that without the burden of a family and kids at that point. But, it was a rough patch for like 3 years. It was great. In fact, not even 3 years. I started buying again 3 years after that all fell out, but it took me many years to really fully recover credit wise, financially, all that. But, that made me never want to do that again. I never want to go through that again. And so I kind of vowed to, not that I felt like I did things wrong the first time around, but I wanted to be uber conservative, uber disciplined, so that whatever we bought, whatever team we built, would be sustainable through another inevitable crash, whenever that might happen, right? Another cycle. And so back in like 2020, the reason I bring this up, like in 2020, 2021, 2022, when rates went to, historical lows and real estate just went gangbusters. We used that as an opportunity to, number one, kind of prune out our portfolio a little bit, just really take advantage of the market. People were offering prices that I couldn't make sense. I couldn't underwrite myself, knowing the asset better than anyone else, and I couldn't make sense of how they were paying that. So we kind of peeled off a few, took some chips off the table. And then we definitely bought stuff in those years, but not much. I mean, I was watching people around me, like, guys that I even helped get into the business. Like, I don't know how they're buying that. I literally don't know how they're making the numbers work. And so we didn't buy a lot. We weren't able to be competitive as a buyer on a lot of stuff. And so, that was frustrating at the time. That was frustrating. In fact, that created some challenges internally in our business, because we had a lot of capital that wanted to find a home, and we couldn't take it. We had to turn it away, and if we're not going to take it, they're going to take their capital and put it somewhere else, which they did. And so that created, stress within the organization, because like we wanted to be able to buy deals, and we just found it challenging to place all the capital that was in the market. And so we didn't, and we just waited. And then now looking back, it was a great decision on our part, because a lot of the stuff that was bought during those years, people overpaid for it, got out in front of their skis. But it put us in a really good position. And number one, we never, ever missed a distribution. Like, we have literally had like 34 quarters of on-time distributions. So we never missed on distributions. And number two, we were one of the few men not left standing per se, but like that actually had liquidity, had a good track record, had a reputation. So when everyone else was on the sidelines in 2023 and 2024, whatever transactions came out that actually made sense, there wasn't nearly as much competition. And, we were kind of like on the top of the podium, like, hey, we'll buy it, we'll take it down. And so it just allowed us to do quite a lot of deals in those 2 years, just due to lack of competition and just other buyers no longer in the marketplace, kind of, running damage control on whatever they bought the years prior. And so This year's proven a little bit more challenging. I think there's more capital coming back into the market. I've noticed that personally, a number of more bidders on projects that come out than what we had historically seen the last 2 years. But, again, we'll keep that discipline. It's treated us really well. We'll buy what makes sense and just, pass on what doesn't, and know that will create, like, that's ultimately created a very sustainable, durable business for ourselves, for our employees, for our investors, and everyone that's involved.
Jack?
So what's the mix of stuff you've bought this year in terms of asset classes?
Yeah, so it's parking and mobile home parks, and we'll wrap up this year with seven mobile home parks, which equates to about 27 million worth of parks. And then potentially another 5 million one that might close by the end of the year. So, 27, potentially maybe 32 million of parks. And we closed on one parking garage, which was, I think, just over $25 million. So it's pretty down the fairway, right down the middle this year. Last year we closed about 115 million worth of property, and only 33 of that was parking. So what has happened with our parking stuff over the last 5 years? We look at a lot of parking to find one that checks all of our boxes. A lot of parking even if it's in a great market, a lot of parking that was built over the last, call it 3-4 decades, a lot of it was purpose built to predominantly service office buildings that are in those local markets. I don't want that. I don't know how to fix that problem. And so while it might be a phenomenal city, phenomenal location, I don't know how to get the people back into the office, right? And if they're not back in the office, then they're not using the parking garage, so we can't buy it. And so for that reason, we look at a lot of parking, and we've only ended up buying one parking deal a year for the last 5 years, which is fine because everything that we've bought, it's performed flawlessly. It's been phenomenal. It's in great markets, but it has to check a variety of boxes, which a lot of parking just doesn't do.
Are those like are the parking deals? I'm curious about that. I really don't know anything about it. Like, are those primarily cash flow plays, or are they some combination of like a cash flow play and a covered land play where you like the land appreciation and you're getting a check in the meantime and you like the combination of those return profiles? Like, how do you think about what a good parking deal is?
And is there any value add that you guys do there?
All the above. It's a great question. Great questions. It's all the above. So the funds that we roll out are a combination of parking and mobile home parks. We classify them as growth and income funds. And most of the growth comes from the mobile home park. Most of the mobile home parks we do are value add, like there's multiple levers to pull. And so there's typically a much more of a growth opportunity there. Whereas the parking is much more of a kind of a core or core plus asset. However, with all that being said, we still are not coupon clipper type buyers. There's got to be at least a couple levers that we can pull. So, there's got to be a little value add component on the parking to where we can, adjust the inefficiencies that are there, adjust parking rates, what have you. And so there's always a value add component. I would say is significantly more in the mobile home park side than in the parking. The parking's generating income day one. And so that's really the income strategy of our fund approach. But then as far as your question about like the cash flow and covered land play, so we always look at parking. We always look at it as parking first. Like, we're not developers. I'm not going to speculate on what it's going to be or what it could be down the road. I want to know that it has the opportunity to be redeveloped. It has the opportunity for air rights. And so it could be something else. It will be something else. But to try to underwrite that and put a value on it, that's not our forte. And so we don't take that approach. We look at it as parking first.
Yeah.
It's got to stand on its own as parking. And we got to feel confident that based on the location, based on the the parking demand generators, like who's parking there and why they're parking there, we got to feel confident that each one of those income streams of parkers, we feel very confident it's going to be there for at least 10 years, if not more. And so, I'll give you an example, like the parking garage that the one we bought this year is it's in historic Philadelphia. It's a standalone parcel. It's right next to the Renaissance Hotel. It's 2 blocks from the Liberty Bell, 3 blocks from Independence Hall. I mean, it's 70% of the parkers that park there are transient parkers, meaning that they're tourists that are coming in to see all the multitude of attractions in historic Philadelphia. I know those attractions aren't going anywhere anytime soon, right? I know that people will not stop visiting. Philadelphia to go visit all those historic sites. I know that will not happen. That's 70% of the makeup, and there's also a massive shortage of parking in that area of Philly. And so, like, you're not building any more of it. It's very difficult to find parking. And then, last to the to the tourists that are using it, the rest of the 30% makeup is made up of 4 and 5 star hotels that are literally on that same block that don't have their own parking. They're big, the Renaissance, and I forget the other one. It's on the same block. It's huge. They don't have parking. In addition to that, there's tons of restaurants and nightlife and everything else, right? Events that happen down there. And so I know that's not going anywhere anytime soon. I know that it will be in demand for many, many years to come. I also feel very confident that when parking is not the highest and best use, whether that's 10 years, 15 years, 20 years, whenever that comes, when that day comes, that piece of land that it sits on will be incredibly valuable, and has the ability to actually go vertical and turn into something else. So again,
Jack, I always think of that surface lot that was at, I think it's 101 Light. It was there forever. And now it's one of the most gleaming, high-rise buildings in all of Baltimore. Yeah, I'm sorry, what is it? There you go.
Do yourself an exercise. Go back on, Google Earth has a historical satellite view. If you go to the top, I don't know if you guys know that, but it's a pretty cool feature. Like, it sometimes goes back to like the, even sometimes as far back as like the 80s in certain areas, 80s and 90s. And you go to a big city, go to any big city, and, look at what the view looked like back then, and a lot of the high rises were developed in the 70s and 80s, and so like it might not be as impactful as if you could go back and look at what it looked like in the 60s, right? But even then, you'll see back in the 80s and 90s, areas that were surface lots, or maybe, some combination of, to where now they are not. They're a building of some sort, right? Like there's much less supply of surface lots. Like go to Houston, go to Dallas, go to Baltimore, go to some of these big cities, and you'll see that that's the common trend. So again, it comes back to everyone knows location is the most important factor in all risk. It really is. Like it's kind of like time typically can heal most wounds. Location, if you got time, location can typically heal most wounds as well. If you buy a property in the right location, the path of progress, knowing that there's going to be a demand for that property today, 5 years from now, 10 years from now, 30 years from now. So that's kind of how we look at parking, but it's got to make money today. It's got to stand on its own as parking today.
What's the cap rates on that? What was the
Yeah,
cap?
so like the one we just bought there in Philly, that was I'd say that's like more of a core plus deal. So it did have a little bit of a value add component. On that one, we went in at like a 6, I think it's like a 6.7 cap rate. We ended up getting debt like 5.8. So right out of the gate, about 100 basis point spread, which again isn't crushing the game of life, but it consistent income day one. And then we've owned it bought it in I think May. The hourly rates, I'm going to just, I don't remember the exact numbers, but the hourly rates were about 12% below market. So we made an immediate adjustment there, no attrition at all, because people need to park, and they just hadn't been adjusted in quite some time. And then we also made some little minor changes. It's crazy. Like people want to feel safe when they park. And so we went in and just, there was lights that were out and things like that, repainted it, basically hired a porter to monitor the garage on a daily basis, clean up any trash, any debris, floating around, restriped it, put brand new lights and really bright LED lights. And literally just those couple improvements alone increased the parking ratio on a daily basis for folks that were not just parking there during the day, but, we're going there for evening, either events or staying at the hotel, what have you. And just little changes like that make a huge dramatic improvement and obviously, go directly to the bottom line.
What does the operation look like to run $400-500 million of parking garages and mobile home parks? Like what are your ops?
Yeah, so we are vertically integrated on the property management side for mobile home parks. So, it's got its own leadership team. It's a independent division. Sunrise Capital Investors is our investment arm. Sunrise Communities is the property management company. Our Sunrise Communities has its own leadership team. It's got a president of operations. It's got regionals. It's got district managers. It's got community managers. It's got, maintenance personnel, and a litany of other folks kind of on that side of the house. I think there's changes all the time, but there's probably 50 or 60 folks on that side of the equation. The parking, and one of the other reasons why we got attracted to parking is, with the mobile home parks, every time we buy another mobile home park, we got to hire more people. Like there's no way, right? We always have to hire more personnel every time we buy another property, right? And property management is not a sexy business. It's not very profitable. It's kind of a necessary evil, right? It's a pain in the ass, if I'm going to be completely honest. It just is. It's a lot of moving parts, turnover, and again, it's not a very profitable business. Like we're happy when we break even with it.
So is that to say you always have to have a new person on site or a couple people on site at each park?
Yeah, every park's got at least one person on site. Some, depending on size, sometimes more. Our largest single community has about 750 sites in it, and so that's got a community manager, assistant community manager, 2 sales and leasing agents, a whole maintenance staff, and there's probably 10 staff members there. Whereas like we've got some smaller communities that have like one person, and then we might outsource like lawn care. Everyone functions a little different next, but at minimum we have one person. And most times it's 2 or 3. On the parking stuff, one of the areas that really attracted us was that it was an opportunity for us. There's a lot of some publicly traded parking management companies throughout the country, some local, some regional, and some on a national or international level. Big companies that have really robust technology platforms and infrastructure. We didn't really want to rebuild that. We had no interest in, nor would we be able to do it as good as some of the groups that have been at it for multiple decades. And so we saw parking as an opportunity to be able to invest in great assets and great markets, deploy a significant amount of capital without having to build out a whole new internal infrastructure to support it. And so on the parking stuff, we literally have, we've got like our finance team, we've got like a full-time CFO and all that. That's not all they focus on, but so we've got some proportionate focus from our finance team on the parking, but we have one dedicated asset manager in-house, like a senior asset manager that essentially works directly with the various parking management companies that we work with. We work with different parking management companies throughout the country, depending on who's the best in that respective submarket. And our in-house asset manager really is the only, if we have one dedicated employee, he's it. Like he's the one that services and oversees the majority of the parking stuff that we own, and everything else is pretty much outsourced because we would never be able to do it cheaper than what these management companies can do. They've got a massive staff, big infrastructure, they're technology
Scale.
forward, and it would cost us millions upon millions of dollars to try to rebuild that and replicate it, and we wouldn't be able to justify because we're just not large enough to do that, right? We don't have a big enough holdings to do that.
It's interesting. I actually had no idea that that was sort of the business model there, that, there's an asset owner and then they just, I guess, nationwide or regional management companies for the lots.
But it's you got to have there's still involvement. Like you got to have involvement. We have
Oh,
weekly call. We have weekly. Our asset manager has weekly calls, and then big monthly calls where we take a deep dive into the financials. Look at, you know, what we budgeted for, the various parking demand drivers, where we're at that month. Why we fall off. Like there's got to be a lot of answers associated with it. There's a lot of moving parts in parking. Like at a high level, when you think about parking, you're like, oh, people come in, they pay, they leave. Like, there's so many
I
variables
can
with
figure
events
that
in
out.
the yeah, with events in the area. Just a litany of things. Busy times for hotels, slow times for hotels, restaurants, kind of the same thing. Restaurants come and go. You got office buildings nearby that. Some people are back to work now. They need a place. They don't really have dedicated parking now. They're like leasing 100 spaces from us. And then this other guy's leasing 50 spaces. They're downsizing, so they're going to stop leasing those 50 spaces. I mean, it's a continual a process, month in, month out, to maintain stabilization in these parking assets. And, it's some of them are just in such a location, like the Philly one. Actually, I'm not going to say you get to set it and forget it, but there's no other option. Literally, there's nowhere else to park, and so
That's a
like
good one.
people are going to absolutely park there no matter what. You still have to have oversight, but like there's no other option. So either you're going to park like 10 blocks away and walk your ass, or you're going to park in our garage no matter what.
Curious, Jack, you have any other questions regarding the lots
No,
parking?
no, go ahead. Go ahead.
Yeah, I'm curious, going back to mobile home park investing. Dipped my foot in the pool on that a couple years ago. Made a pitch to a small boutique shop that would, basically be that a small hedge fund, essentially. I was working with a guy that raised a couple $100 million for, sort of a mid-tier park provider. And so a couple of things that come up with me that I'd love to get your take on. I feel like, self-storage was the natural migratory path of all real estate, single family and multifamily investors. It felt like over the past few years, like a lot of them were flocking to the smaller tertiary markets for self-storage. And what I feel like mobile home park investing is right now is sort of like that same disjointed, you know, the stereotypical guy is 70 years old, his kids don't want anything to do with the park. Like, tell us about, one, how you're finding the deals. It's not an easy database to sort of figure out like the 35,000 parks in the United States and then sort of calling, which ones you're interested in. So that from a marketing standpoint, I'd really be interested in hearing what you've learned with that. And then talk about, are you finding these deals off market? Do you have a broker network that's bringing them to you? So interested in
Yeah.
hearing about how you built that business.
Yeah. And I'll do my best to unpack, hit all those points there. So backing up to when we first started buying parks, I bought the very first one off of LoopNet, which is probably one of maybe only two parks we ever bought off of like
There's
LoopNet
no
or Crexi.
competition there.
Yeah, well, it's actually the broker did a horrific job of listing the park. It's probably the only reason why it was still listed,
There
and
you
um
go.
and we bought it. He did, like, the listing was the worst listing I've seen to date. There's no information. He didn't know anything. He was hired by the servicing company. He was a residential broker. Didn't know anything about mobile home. I mean, it was.
Perfect.
Yeah, it worked out well.
Chef's.
But at that stage, we quickly realized that we couldn't go by the list. I wanted to really carry over a lot of the tactics that had always worked
Yeah,
for
yeah.
me for finding single family stuff, like, again, all that guerrilla marketing, and realized quickly that we couldn't just go buy the list from a list broker. And so I had prior experience during my little 3-year hiatus, '08 to like '11. I had to still put food on the table. I had to be able to eat. And so I started a few side businesses not related to real estate. Um, in those side businesses, I learned I didn't, again, this is like shoestring budget. I truly, like, all my bank accounts got garnished. I didn't really have any money. And so I had to learn how to hire virtual assistants, like VAs over in the Philippines. Like, that was a new thing. It's pretty
Oh yeah.
prominent now, right? But like, that was a new thing back then. And so anyway, I learned how to hire and manage staff overseas with those other businesses. And so I kind of carried that forte into building a database. So I hired a team, learned how to do it myself, put a system together, taught them how to do it, and had like literally at one point a team of 6 VAs. That's all they were doing was building out this database nationally on my behalf.
Was that like a lot of Google Maps type searching?
Yeah, like the initial stage was like Google Maps. I mean, because you can visually see what a mobile home park looks like from an aerial. And so it was kind of like just breaking up the country in a grid, right? Literally what we did. And then literally in that grid, like this is your focus for this week or next, right? Like this grid by grid by grid. And once we got that grid done, we exit out, move to the next.
Yeah.
And so we did that. And literally up until probably 3 years ago, nearly every property we've ever bought that's in our portfolio was direct to owner. And a lot of the long-term relationships, cold calls, mailers, but long-term, just maintaining a relationship with a mom and pop. But over time, this industry has become very consolidated, especially like larger parks and good markets. I mean, like other groups like ours, lots of them out there trying to buy or have bought. And so it's not as many mom and pops anymore, and some of that more in the larger markets, or even some of the better secondary markets. It's definitely like any parks that are like 100 space or larger. I'd say probably 60 or 70% of them are owned by groups like ours or larger groups now at this point in time. And so for that reason, we've had to really evolve from off-market stuff, direct to owner, to really leveraging broker relationships. And we do both still. But I would say over the past 3 years, 70 or 80% of what we bought has been broker relationships to that of direct to owner. I think there's an opportunity with the direct to owner on the small stuff still. Like if you're looking at, 30 space parks, 40 space parks, and especially like secondary and tertiary markets or rural markets, like you probably still have a better chance of just going direct to owner and that stuff. And you could probably, get a better deal doing that. But that, we kind of have a certain size that we go for now. For us, it's location is much more important than trying to buy at the, at the best cap rate, right? Like I think location typically always wins out than trying to buy a property at the highest cap rate, thinking I'm paying the lowest lot, lowest price per lot, but it's in a rural market, right? Like who am I pulling from? Like who's living there? Is there a demand for affordable housing? Whereas I know if I buy it in the middle of heart of St. Louis, a suburb or whatever, anywhere, Tampa, I mean, like it's real. Like you're not building them anymore. There's a high demand for affordable housing. The median home prices are 400K plus. I will pay much more for that type of product than I will trying to steal a product at a 10 cap in a rural market. So no right or wrong there, but I think there's an opportunity still for direct to owner off market stuff on that smaller profile deals.
I agree. And so the assets that you're looking for now, is it a mix of like park owned homes, tenant owned homes, and then do you try to switch everything over to tenant owned?
Yeah, I mean, in a perfect world, we wouldn't own any homes, but that's unfortunately, it's just not how it functions. Like you got to be in this business, you have to be willing to own homes or even buy new homes and bring them in, right? And in one form or fashion or another, like you're going to own homes. We own a number of communities where we own zero. They've always operated that way, and they've got a really stable, mature tenant base. People don't move all that often, and when they do, they put their home up for sale, just like you would a stick-built home, and they sell it to somebody else, and then we just get our lot rent, which is beautiful. Then we have other parks where 40% of the homes are owned by us. And most of the time it's because we inherited it that way. We bought it from the prior ownership, and they had built a model or accumulated homes of how they ran it. And when we bought it, we basically acquired them. We assumed their homes, but we always have the intent of selling those homes off. We have different renter conversion programs that we have in place. If we are acquiring rentals and we can't convert them, we'll wait till they go vacant, renovate them, and then turn around and sell it to an end user. We have different finance companies we work with to help finance, the end buyer. We do lease to owns if we have to. So like we've got a multitude of processes on how we get to the end game, which the end game is not owning the home and getting someone in there that's going to actually be responsible for that unit. And for the most part, it's the reasons behind that is like the residents become much stickier. Retention rate is significantly higher when they own the home than now when they rent it. And so I want someone that's going to be there for multiple years and not necessarily just turn over every 12 months. There's no money to be made in rental units unless you're in a market where the rents are like $2,000 a month, which there's not many like that for mobile homes. If you're in a market where you're renting it for $1,200 a month on a rental and you turn it every 12 months, you got to go back in and put, $6K, $7K into it, paint, carpet, and, drywall repair, have 2 down months of not collecting rent. Any profit you thought you made is gone, right? It's wiped out. So we prefer not to own the homes.
Jack speaks about that all the time. Tenant duration.
It's the killer.
It's huge.
The killer that everybody fails to underwrite. They
absolutely. Yeah. So we always push really hard to convert. In fact, I'll go as far and do it often where I'd rather lose money on a unit. Like, let's say I'm into a home for 40K. I got a buyer that comes in, they qualify credit wise, they've got good stable income, and they've got cash in hand of 35K. Cash is king. I will lose 5K all day long. Because number one, I know if they buy that home outright, they don't have another monthly obligation of a mortgage payment, right? And so like their underlying lot rent's probably $400 or $500 a month. There's not many things in the world that can happen. Well, not even that, but like there's not many things in the world that can happen that if they have a hard financial month that they can't figure out a way to come up
Yeah.
with $500 to pay it. On top of that, this thing that they own free and clear is now at risk. And so they're going to do anything in their power to not lose that home because now that the home sits on the lot, like if we have to go through an eviction process on the lot, they got to figure out what to do with that home, either move it or we repossess it. Right. And
A $35,000 home.
yeah.
Yeah.
So I'll lose that 5K all the time.
They ain't moving it either. Like
they ain't moving it. No,
the cost of picking that thing up off the putting wheels back on it is what, 15.
Well, if they didn't have the $500 to pay the lot rent, right? Like they're not going to lose their home. So like that's got, it's like they're going to prioritize getting that lot rent paid and not run the risk of losing that home. So I'll lose money all day long to get because I know that once they move in there and they own it free and clear, they're going to stay there for a very, very long time.
Would you say the same applies in those tertiary markets that folks might be listening to the podcast right now and they're saying to themselves, I've thought about getting into the mobile home park space, but they're not coming in with, 150 lots. They're going to go out to one of the tertiary markets. Would you say that the same philosophy applies on, hey, if you can get tenant owned, great. Are you going to get the better tenants there? Are you just going to have headaches? So what's your take there?
Yeah, I mean, it really depends on the submarket. It also depends on how it was run historically by the prior owner, right? If the prior owner had a high pride of ownership and he did a good job of only selecting high quality tenants to live there, check credit, made sure they didn't have criminal records, then I think you can get very stable parks like that, even in rural markets. I would say the market's the most important part. I mean, if it's how you could say, like you could buy the prettiest park, but if it's in the middle of nowhere, there's literally one employer, and the risk of that employer going overseas is real, and the schools aren't great. It's just not in the path of progress. Population's declining. Like I can't fix any of those other things, and so while you might be buying this pretty park, you just need to know that inevitably, once your current resident base, either you have a slow attrition where people just, move, maybe they move for jobs or whatever else, or like they die at some point. Like who are you backfilling? Like who are you attracting to live there? Who needs to live there? Is it a market to where actually affordable housing is in need? I know everyone says like affordable housing is a problem nationwide. That's not entirely true. There are definitely some parts of this country where you can affordably live. Lots of those areas though don't have really good economic basis. They're not really good employment diversity. There's not good job options out there. And so, yeah, I would be very, very, very careful of those types of buys. Just make sure that you're very comfortable and confident in the market. First and foremost, the market has got to be compelling enough to say, hey, man, there's something going on here. There's energy here. There's people that live here and they want to live here. And here's the reasons why. It's schools or it's jobs or these couple employers, and there's diverse employment base and all these things that people want to stay and live in that area. Only then would I consider buying something. So it's like market first and then property second. I'd rather buy a really rough, rundown, just place that's full of drugs, sex, and rock and roll, but buy it in the middle of Tampa. Because I know what I can literally wipe the slate clean. Because I know there's good people on the outside. If I make this nice, I know there'll be people waiting in line to move in. And so the bad element is temporary. I can get rid of that because I know the market's so strong that I can bring people in that were willing to pay double the rent, triple the rent if I make it nice enough for them. You can't say that with like that rural type of park.
What's your take on utilities? So a lot of these parks have private utilities, septic ponds, crazy like that. What's your take on buying that?
No pun intended, huh?
Sometimes I do it. I don't even know I'm doing it.
That's funny. Yeah, no, we own a mixed bag. You just have to understand it. We don't own anything that's on a lagoon, which is basically a big open cesspool where sewage goes and gets treated. We do own parks that are on well systems. We do own parks that are on wastewater treatment plants. We own parks that are on your traditional septic type systems. It's all about due diligence. I mean, you gotta, when you're buying it, you gotta, get engineers involved, professionals involved to come in and assess the systems, assess the operations, understand the regulatory structure on a state level around that system, and just go in eyes wide open. I mean, these systems like these wastewater treatment plants, they're no different than that of what the city you live in or the municipality you live in that they use. It's just a scaled down version. So, but things break. They're mechanical, right? And they have a useful life expectancy to them. But if they're maintained, they can last way past that. If they're maintained and kept up with and repaired and upgraded. Oh, we own all the above. I'd say the funny thing is a lot of people put the emphasis on the sewer systems, like these private sewer systems, and that scares them. The thing that's actually scarier when you really think about it is a well system. Like you can't poison somebody with sewage unless they're out there drinking out of it, right?
Really?
But with a well system, like you're responsible for the livelihood of the entire community of providing clean, safe drinking water to the entire community. And so if you slack, which we don't, we hire professionals. We don't operate our own wells. We bring licensed individuals in whatever market we're in that literally monitor the well, sometimes daily, sometimes week, depends on what the municipality requires. They report to the state, they do samples and all that stuff. But if you are lackadaisical in your well and you slack, or your well gets infiltrated, you're responsible for that. There's a big liability there if you don't manage it correctly. So it's nothing to be scared of, but like again, go in eyes wide open and make sure you do your due diligence.
Jack?
You mentioned a partner. What's your partner do?
Yeah, so if you had to bifurcate our company down the middle, I'm more in the handle all acquisitions. Again, we got a team underneath us, but like generally speaking, acquisitions, debt placement, and then also I oversee our president on the operations side, so the property management. So I'm very involved in like the nitty gritty side of the business. I always have been. It's just kind of my forte. Whereas he's always been on the capital raising side of the house and kind of behind the scenes structure, like our accounting team, finance team, all that. Again, we each do quite a bit more than that, but he raises capital. I find opportunities to buy, and then I oversee the operations side to ensure that we operate them efficiently. If you had to simplify it,
I would have thought with the podcast presence, you were the fundraiser.
Yeah. So, I mean, I didn't start the podcast for that reason. I mean, I started, for an entirely different reason. It's because there wasn't anything out there that existed 11 years ago.
Yeah, you got it early, man. That's pretty cool.
Yeah.
Really
yeah.
cool.
I was an early adopter of podcasts. So I used to listen to podcasts for years driving. And I'm like, man, there just wasn't many out there. Mostly it was like single family, fixed flip, wholesale podcasts. I think Jason Hartman was around and the Real Estate Guys radio show was around. That was about it. And a few others.
Joe McCall. Joe McCall was a very early adopter.
But it was mostly like, wholesaling, right? Like that was his business model.
Yeah, exactly.
Yeah. And so I was like, well, shit, I mean, if I'm seeking this info, I'm sure others are as well. And that's why I started it. I didn't start it to try to raise capital. I never even talked about deals we were working on or anything. I never like gave a pitch on the show for probably until 4 years into it, to where I had enough people kind of reach out and say, hey man, like, heard you working on this project. We'd love to get involved. And finally, like we kind of put our heads together and say, I should start not promoting, being obnoxious, but like just start make mention of what we're doing at Sunrise. And ultimately it became a big fundraising tool for us. And we brought in a significant amount of capital as a result of relationships that we have been able to build through the podcast, but it was never originally built with that intention.
Did you ultimately, I was going to transition to sort of the philosophy around the podcast, and so good segue. Did you ultimately go to in terms of listenership and folks that may have wanted to, hey, this guy's doing, sounds like he's got a great business, definitely knows what he's doing. How do you capture that person as a lead then to possibly invest with you? Do you guys have like a funnel set up for that?
We do. I mean, back then it was, way back then it was probably like sending, I don't know, or send an email to whatever the email address we had, info at, or, and then that would literally go to Brian. Up until probably 5 years ago, Brian literally was our IR team, my business partner. He was the IR team. He made every call, talked to every investor. And now our IR team is, I think we got like 12 people on that side of the house, right? Between like investor relations, lead management, all different parts of the funnel process. And so we got a couple sales guys on the back end that, basically, close any qualified leads that come in. But back when it was literally Brian. So whatever that lead, it was just very basic. Came in, Brian, give him a call, and that was it. That's how it started. So today it's a lot more formal.
Great. So we've had you for about an hour. Don't want to keep you too long. What's your take on, give us, the highlights of the next 12 months for you. Like, what are you excited about? What's moving the needle for you? What do you think?
Yeah, that's a great question. I'd say we have placed a huge emphasis over the past, I'd say, call it 3 or 4 years on our team. And we've made some great hires, and we've really spent time focusing on getting the right people on the bus.
Can I stop you there? Good question. So how much of your team is here in the United States versus the VAs that you got so great at managing?
Yeah, I think only I'll answer that in reverse. I think there's about 8 that are maybe 8 to 10 that are outside the US. Everyone
Hmm.
else is domestic.
Okay.
Yeah.
Yeah. So,
And there are different parts of our business. I mean, there's some on the Sunrise Capital side that are in the Philippines. We've got a couple of folks that have worked for us for now for like 6, 7 years maybe in Mexico. I think 3 or 4 in Mexico, and then there's maybe 4 or 5 in the Philippines, and I believe one of our analysts is actually in India. I think 10 give or take. Everyone else is domestic.
so you mentioned you started to say you've set up this great team.
Yeah. So I think what I'm most excited about is just our no, you can't do it alone. We're at the size where like, there's only so long you can wear so many hats. And we've over the last 3 or 4 years, we've really put emphasis on bringing the right people on the team. But even more important than that, I think we've built out a legit leadership team. Folks that are way smarter than us, way more qualified than Brian and I might be in certain areas of the business, and that's allowed us to really scale over the last couple of years and scale comfortably and make better decisions. And so now that team and that team's now truly really been in place over the last 3 years, and then really the last year, everyone's really hit their stride. And so I would say I'm most excited about the ability to go out and when there's an opportunity, when it presents itself. Historically, there are years past where we'd have more like we would look at things, we were like, well, let's not do that one. That's going to be too much of a strain on bandwidth, right? Like, let's pass on this one, that one. Let's pick the easy ones, the low
Sure.
hanging fruit.
Sure.
Whereas today, like we've got the team to where we can deal with more complex deals. My bigger portfolios all in one fell swoop. Whereas like if you'd have brought to me maybe 3 or 4 years ago, hey, I got this 10-part portfolio, it's 3,000 lots. I've been like, man, I'm excited, but I can't even like we don't have the team to even run due diligence appropriately in the allotted time frame on that deal. Like maybe we could raise the capital, but I don't feel comfortable getting through the due diligence, and I don't even know if we have the ability to onboard that damn thing. Like it's going to be chaos. It's going to be a mess, and so for that reason, we would have passed on it. Whereas today, I know that they can pretty much handle anything I can throw at them at this point. In fact, they're like saying, "Come on, bring it on, buy more deals."
That's cool.
So that's exciting. And again, we will never buy anything just to grow our lot number or say we have a higher AUM. Like we're still maintain the same discipline, but maybe be able to do, not hairier deals, but just more complex deals. Maybe deals that like in the mobile home park space, the deals we used to always pass on were deals that required big infill, meaning like we'd have to go buy new homes and bring them in. We'd have the capital to buy the homes, but it's a logistical pain in the ass to actually bring home, not just bring them in, but actually have a whole sales process, right? Like you got to sell you got to get them
Yeah.
set, and then you got to sell them, and that takes manpower to do it, and it takes systems and
Time.
processes in order to do it efficiently to where you're not losing your ass. And so we can do that now. I mean, we just bought a portfolio where we're going to infill, I think like 120 homes over the next 4 years, and we just ordered the first batch of 25. Like honestly, I wasn't even involved in picking the floor plans. I mean, like, which is beautiful, So I'm like, I know that the guy that's picking them, he worked for another organization. They had like 20,000 lots, and he was a part of it from the ground floor and helped them grow from like 4,000 lots to 20,000. And like infilling 20 homes, 25 homes, it's like he'll do it in his sleep.
What do they need you for?
And they can do a better job than I. Yeah, he knows what people want. He's been there and done that, so I don't have to be involved, which is a beautiful thing.
Jack, I'm interested to hear your take on that as well. Like given the growth of the Dominion Group and Dominion Properties over the last several years, and putting in the right leadership and personnel. Like, is there anything that would scare you and Fred at this point from an acquisition or development standpoint because you feel like you've got just better people in seats?
Yeah, I think that one of our great regrets is not hiring better people earlier. Like we did a lot ourselves for a long time, and so we cut our teeth and we like feel very confident. We know lots of aspects of the business, but we spent a lot of energy and took a lot of gray hairs doing work that if we had just brought in the better people earlier, they would have done a better job than we did also. So like at this point, I am highly confident that that all of our departmental managers are better at their jobs than Fred or I would be. And that has allowed us to scale and scale without stress. We still have a machine that does a certain thing though, right? Like it is not a machine that does all things. But we've the skill set has expanded a little bit, and we can take on a little bit bigger projects. And one of the things that Fred and I are often wrestling with when we're like evaluating opportunities is like, hey, how is that going to fit with this particular machine that we've built, right? Like, can this is it, how closely adjacent is it to like our core business? And, and if it's a little bit too far and we realize that like, hey, we largely measure, is this a shiny object or not, by how much stress is this going to impose upon the people who are really running the company at this point? And, so I wouldn't say that we've built a company that can, do all things in residential real estate in Baltimore. And that's pretty niche-y already, right?
Yeah.
But it's a lot better than it was before we'd, invested in great people.
Yeah.
So
And I think a
Kevin,
lot of us go through that evolution of, you wear all the hats for way too long, right? Like it's just, we always should hire way sooner than what we do. And only till you realize you get all this talent in place, you look back, you're like, damn, I should have done that sooner. Life is so much better and a little bit easier.
I mean, also cash flow, right? Like you also have to be able to afford, like you have to do enough business to be able to afford people. And then there's that interim period where you're like, you invest in the people and you're like, this better pay off, because otherwise, like, this is a leap.
You have to take, you have to take a step back personally, right? Because you get to the point where you just start making money in your own business. You're like, I'm actually now getting paid for the time I put in. But then you get that weird pivotal moment where you're like, I need people, but that means I need to stop basically paying myself, or, cut that back quite a bit so I can actually pay them. And then you're like, to your point, like, this better work out, and it's like you almost you thought you made it, and then now you got to reinvest a hefty amount and basically bring risk back into the equation, because bringing anyone new into the fray, there's significant risk with that, right? Yeah, it's a big investment, big time investment.
We're going to take
money
2 or 3 years back, 2 or 3 years step back in terms of like cash flow and profitability, because now we've like jumped up payroll a whole bunch on faith that these people are going to work out. It's a hard leap to make.
Kevin, I'm curious. I love the getting back to David in your life. Do you speak to him at all anymore?
We stay in contact. Yeah. I mean, probably not as often as what we did way back when, but yeah, it's probably a couple times a year, like holidays, that type of thing. He lives out west now, out in Cali, and not that makes a difference, but so if I go visit family back in Pennsylvania, like historically, that's where he lived as well, and I would see him just, by default, by going back home, to visit people. But yeah, we stay in contact. He's still doing well. I'm 46. Yeah. So he's old. He's older. He's up there. Right. So he's kind of at a different stage of his life, just kind of relaxing and enjoying the sunshine and not doing much, just playing tennis and chilling out.
As it should be.
Yeah.
We speak to investors every single day. It's that wearing all the hats that can be very stressful on new investors, sort of intermediate investors wanting to get to the next level. And so I've always found it particularly important to have great mentors and sort of folks that have been there before you. And I think the more that new and intermediate investors can find those people in their lives, the better things generally turn out for you.
Agreed.
Great story. Thank you for giving that to us, man. It's been a pleasure speaking with you. Can you tell folks where to find you online, where the podcasts are, where to find you if they want to know more about Sunrise?
Yeah. So Sunrise, if you want to learn what we're doing over there, check out our offerings, or we've got case studies on the website, some white papers that we give out for free as well. You can go to investwithsunrise.com. As far as social, I'm pretty active. I'm very active on LinkedIn. Also active on Instagram and Facebook. And I always joke and say my last name, Bupp, B-U-P-P. It's unique enough where if you just type in Kevin Bupp on any of those social platforms, I should be the first one that comes up.
You are.
Yeah. It's one of the positives of having a weird last name. And then the podcast, you can, I think we even have a link on our website, investwithsunrise.com, but you can find it everywhere, Apple, Spotify. I don't know where the other places where people listen to their podcasts now. Apple and Spotify are the only two I can think of. There's probably 100 others, but
you capture those, you got 90% of the market.
That's right.
Well, man, thank you for taking the time to be with us today. Love to have you back on in the future to hear about how the company's growing, and just can't thank you enough for your time. So really appreciate it.
No, I appreciate you guys having me on, man. It's been a fun conversation, very enlightening as well. So appreciate it.
Yeah, it was a real pleasure. Real pleasure.
All right, guys, that's Real Investor Radio with Craig Fuhr and Jack BeVier. We'll see you on the next one.